All right, guys, so I recently had the distinct pleasure of chatting with the one and only Jeremy Lefevre. We had a really fun conversation and got into all sorts of things, like how he researches stocks, what he thinks will happen in the stock market and in the economy over this next year, and we even got to go under the hood to see inside his dividend portfolio, which was really cool. And I asked him at the end what he thinks is the most overrated stock on the market, and his answer was actually really surprising. But anyway, I hope you guys enjoy the conversation. Now let's jump over to Jeremy. All right, guys, so I am here with a man who needs no introduction, the one and only Jeremy Lefevbre, who is undoubtedly one of the real OGs here in the finance and investing community on YouTube. Jeremy, first and foremost, man, how are you doing?
Doing well, and thank you for having me on. Looking very forward to today's video. I've been, tracking your channel for a bit, and you're providing a need in the marketplace that definitely needs, a lot of attention. Dividend investing, on YouTube especially, a lot of people love to talk growth stocks, and growth stocks are fun and those sorts of things. But not growth investing is not for everybody. And I think dividend investing, building out a great dividend portfolio, is a very important thing. Regardless if you want to do just that, or even if you are a growth investor, like I'm such a believer in like GVD, growth value dividends, and so yeah, I appreciate everything you're doing out there, the content you're putting out, and looking forward to chatting about a whole variety of subjects here today. So,
well, thank you, man. And I got to tell you, like, when I first started doing this stuff a few years ago, I'm only about, I'd say 3.5, 4 years into my investing journey. But when I first got interested and wanted to learn about this stuff, go to YouTube to figure it all out, as many do. And one of the first channels I stumbled upon was yours. And so throughout the years, just both as an investor and as a creator, you're someone I've always really looked up to and learned a lot from. So thank you for all the inspiration and all the motivation. This is kind of a full circle moment, a very serendipitous moment for me. So I really appreciate you taking the time.
absolutely, my pleasure, man. And I'm glad you found the channel. I'm always thankful that people can find the channel out there, especially if you're a newer investor. So.
Yeah. Well, getting into your portfolios, man. I know you've got a few of them. Walk me through just real quick your different portfolios. You got the public account, you got the dividend portfolio. What's going on with both of those? Where are they both sitting at right now, just in terms of value? I'll even put them up on the screen as we're going through it. But tell me about those.
The public account is my big dog portfolio that I started. That's a public account there. That one I started, oh gosh, probably over 5 years ago, maybe close to 6 years ago now at this point in time. And we've just been building it up, ever since, essentially. And then I have my dividend only portfolio, that one there, which is, you can only get in that portfolio if you're a dividend paying stock. And that one I started, maybe 3 or 4 years ago. And what's been really fun about that portfolio is just trying to see, like how that would perform versus a public account over time. A dividend only focused account where it's all about just getting the cash flows, using that cash flow to buy more dividend stocks and things like that. And it's been fascinating to watch the performance of those two over time, because last year the dividend portfolio was holding pretty dang strong. It was amazing. This year, the dividend portfolio is getting absolutely smoked because obviously the public account, the biggest positions are like Meta, Tesla, Palantir, Amazon, like some of those stocks that have just, kind of been on a rocket ship ride this year. So it's been really fun. And if anybody's not familiar with kind of my investing philosophies, growth, value, dividends. So I love to, invest in growth stocks, obviously, and then value stocks and dividend stocks. And the way I look at it is those value stocks and dividend stocks are really your protection, because there's going to be certain moments in the market where you're not getting any gains, or growth stocks are not in favor. Like, no one wants a piece of growth stocks. Meanwhile, you're still making that cash flow from those dividend stocks. You're getting paid out every 3 months from all these different stocks. And as you build bigger and bigger, next thing you know, it's like hundreds of dollars and thousands of dollars. If you're building really big, you're talking about tens of thousands of dollars pouring in that you can go ahead and then buy stocks for, if the market's in a tough place, for much cheaper prices, which is kind of a beautiful thing. And the way I almost kind of look at it is like a boxer. If all you know how to do is throw a punch, you're not going to get too far in the boxing world, right? You got to know defense, you got to know all these little tactics and things like that. And so becoming a very well-rounded investor over time, you kind of got to learn all the disciplines, because certain time periods, like right now, is a great time to kind of be picking value and dividend stocks. Like, that's actually where I'm mainly focused this year, versus last year was mostly growth stocks. Certain time periods, like growth stocks, are going to be super overvalued, and you're like, dude, where are the deals here? And that's when you go to the value and divs. Are there deals there, and you can find opportunities, right? Or vice versa. So, anyways, that's kind of my strategies, and those are obviously the two main portfolios out there. And yeah, I just enjoy the aspect of growing them, and hopefully, someday the public counts a $5 or $10 million portfolio. That's a goal over time. So,
I mean, just based on your age, you're 34, 35, right?
33.
33. Okay, my bad. I don't want to overage you too much, but
Yeah, you were
I mean,
close.
it's inevitable. It's inevitable. That one's 1.7, $1.8 million. I don't see any reality where that doesn't hit that number at some point. And kind of going back to what you were saying a moment ago, just in terms of how you're maybe allocating your contribution. So because you're focusing, maybe prioritizing more the dividend portfolio right now, are you not contributing as much to the public account, the growth portfolio, or how does that work? How does that work for you?
Yeah, I still buy. So I buy $250 in the dividend portfolio every week, $250 in the public account every week, and $150 in my Patreon portfolio every single week. But in terms of big additional capital, not really funneling anything in the public account right now. Really, what I'm up to is dividends and values are really like what's attracting me right now. So I'm putting money in those, and then also I'm doing a little bit of combinations of some hedges right now in case we have some real economic weakness. In case we have a recession, obviously in 2024, and then also stacking a little cash right now. It's a really it's the most attractive. I've been in the market 15 years. There's never been a better time to be adding some cash than right now, because right now on a savings account you're getting 4.25, 4.5% if you've got a good savings account. Obviously short-term treasuries are paying 5% plus. I mean, that was never even like something we could have considered in the past. And so the fact that you have that right now is very, very attractive, and especially with S&P large caps trading relatively rich. I mean, it's a great time to kind of do a little bit of everything, doing a little buying. There's opportunities out there, doing a little bit of hedging in case things get rough in 24, and then also adding some cash because you can get a great return on cash right now. So that's kind of what I'm up to, at least in the short term. But based upon market, things can change very quickly. If the market tanks all of a sudden, you're going to see me out there buying a lot heavier. If the market goes up a lot, you might see me cashing up a little bit more. So, I kind of move with the market in terms of that.
Yeah. So when you say hedging, is that what those put options I saw, what those put options were that I saw in the public account, or is that something different that
No,
you're
that's
referring to?
correct.
Okay.
So I just started doing some hedges inside the public account for next year. So I'm going to do another
Mm.
$10,000 worth of hedges in September. I'll do another $10,000 worth of hedges in October, and then I'll consider another 10K potentially in either November or December. And those are options just in case. I mean, obviously, there's considerable risk out there right now. We're at a very interesting moment because unemployment's still relatively low. The economy's held up way better than almost anybody anticipated.
Yeah.
But yeah, but on the flip side, you've had the Fed, rates the highest they've been pretty much in multi decades, and eventually they usually catches up with the economy, and so that's why we're at a very interesting time period here where it kind of feels like are things going to eventually break at some point next year, right? And we kind of maybe
Yeah.
got a little taste of it with SVB and some of the regional banks, and so that's why I'm just watching myself hedging up a little bit, and I'll continue to do that for at least the next, I would say, 12 to 24 months in terms of some hedges out there.
Okay. I was gonna wait to bring this up till later in the conversation, but we're on the subject. I mean, kind of like you were saying, there's been a lot of confusion in the market and in the economy lately. Things have been up, things have been down, hard landing, soft landing. I know it's kind of impossible to predict what's going to happen in the future, but do you have any thoughts as to what is to come for the rest of the year and also as we head into 2024, not just in the stock market, I mean, certainly there, but the economy as a whole, fears of a recession, interest rates, whether or not
Yeah.
we'll have a hard landing or soft landing. Do you have any thoughts on any of that?
Yeah. So I think if the Fed is able to, bring down rates at a relatively quick pace before things could potentially get ugly, I think then we could be talking about maybe a soft landing or maybe a medium landing. The problem with the Fed usually is they go too far for too long, and they already did this a couple of years ago. Inflation. Anybody that ran a business already knew inflation was going wild in 2021, and yet the Fed stood by, kept rates at zero. and kept kind of their we can call it monetary easing and everything that they were up to there, right? And then by the time, they start raising rates in 2022, I mean, inflation was already out of control. So we know they can make a mistake. And so there's very much a possibility that they keep rates too high for too long. The dominoes start falling the wrong way. The economy really starts getting hit. By the time they start cutting, they're late to the game. And then we have kind of 1 to 2 years of pain out there, right? Where the unemployment rate climbs to whatever number it climbs to, and where we're just in very soft economic conditions. So I think that's the main risk. We'll see. We'll see if they're able to get through. We should be fine as far as at least unemployment goes for the remainder of this year. We're looking pretty good. But I think 2024 in general is just a big question mark. So I don't think it's a lot of people have been kind of doomsday for the last year. I would say the last 12 months, and I wouldn't go there though. A lot of people have been betting heavy on short positions, put options, just getting absolutely slaughtered. I mean, just losing their entire portfolios because they were so convinced like we were going to tank and the economy was going to tank, and it's just things are taking a lot longer than a lot of folks anticipated, and the economy's held up a lot better for a lot longer than anybody anticipated. But I mean, I think the one thing a lot of people didn't consider is how much stimulus they really did, and how much money they pumped out there in the system. In that, you're going to need to keep rates high for a pretty good amount of time until you kind of get rid of all that and you kind of cause enough damage out there. Because we never went through a situation where they literally pumped trillions of dollars into the economy like they did. And to then get that out that's a challenge, and it takes a lot more time than I think a lot of folks anticipated. So, but yeah, that's kind of where I'm at. So the thing is, I just want to position for any scenario. Growth, great. A slower time, great. A bad time, okay, I got my hedges, that will make me a lot of money. I can flip out of those hedges at some point in 24, put that into long positions at much cheaper prices. So regardless of what happens, I don't mind. If the stocks go down a ton, I'll also buy the dip. I got a good amount of cash on the sideline. So, that's the magic. If you can, where people get into danger when they go all short the market, they're so convinced it's all going bad, or they're all in the market, or even worse, they're on margin and all in the market. That's a very dangerous territory, because then you're counting on the stocks just going up and the market going up, and as soon as it flips the other way, you're just pulling your hair out like, come on, man. So anyways, that's kind of my perspective on that.
Yeah, I mean, do you mess with margin at all, or is that something you tend to stay away from?
I did back in the day. This was like 2014 I got into some margin, in 2015, and it went really bad. Really, really bad, because the thing about margin that's very addictive is you see it there in your portfolio, and then let's say stocks start going down, you're like, oh, let me just buy a little bit on margin, and then you're like, let me buy a little bit more on margin, and then you're like, let me buy, and next thing you know, all of a sudden you're in a situation where your stocks are getting close to margin calls, and then something goes wrong, the market freaks out, and next thing you know, you got a margin call, and then you're like, oh my gosh, I have to sell this stock I love at such a bad price. Like this is, and so margin, what I would say for folks is stay away from it. I have my account set up for margin, so that way I don't need my money to clear. I can invest it right away. It doesn't need like the 3 to 5 days. But in terms of like the public account, for instance, I could do $1.7 million of margin. I have $0 on margin in the public account, and I have no plans to margin that one out. Is too stressful, man. Way too stressful. As a long-term investor, it's very alluring, but no.
Yeah, that's exactly it, man. I'll get comments sometimes, not too often, but every now and again I'll get comments from probably beginner investors, because that's typically where my audience skews. And some of them will say that they borrowed some money to invest in stocks, just like as they're just starting out too, just kind of wanting to rush things, build up, especially for dividends, get cash flow super quickly, and they'll always, like 9 times out of 10 they'll end up putting that into something like a covered call ETF, like a JEPI or QYLD, or we're seeing even now, I don't know how much you keep up with this stuff, but the yield max ETFs, are you familiar with those at all?
I have never invested in any of those before.
So these yield max ETFs specifically are basically the fund will write call options. I guess they're called synthetic call options on stocks like Tesla. There's one for Apple. There's one for Amazon, Berkshire Hathaway. And they're yielding something like 30, 40, 50% sometimes in terms of the dividend yield. And they just came out too, like a few months ago. But I've seen a lot of people pile money into stuff like this. And I've gotten a couple comments. Luckily, it's not been a lot. And hopefully I don't get any more of people taking margin to buy those sort of things. And I don't know. I can't help but think that's just a terrible move, especially for someone just getting going.
Yeah, 100%. Yeah, even if you're sophisticated, it's a problem, and you've been in the market a while. In taking myself back to that story from me from kind of like 2014, 2015, for me, I got great returns for many years in a row because I started 08, 09 investing, and then 2010 I killed it, 11, 12, 13. And so for me, it was just like, oh man, look at these returns I'm getting. Look at how much money I'm making. Only I had even more money to invest, and that's where you start thinking margin.
Right.
And even if you're sophisticated, it's not worth it, and you've been in the market a long time, but especially if you're newer, it's just, it's usually going to end bad. It's just a question of how long does it take to end bad, like 6 months, 12 months, or like 24 months.
Yeah, absolutely, man. And kind of on that note, like take me all the way back to the beginning. It's just as far as investing, how did you even get into this stuff in the first place? And what made you think like this is something that I need to be doing?
Yeah. So with me, I mean, it really started kind of around college, when I went to community college, and I had I was at that time I was really still trying to figure out like where I was going in life. Like I didn't have it all figured out. Certainly, this is like 2008, 2009, and I had a really good accounting teacher, and he was actually a gold bug. But what he loved to show us a lot of times in accounting class, he would like before class kind of started and got rolling, he would just show us different things and give us kind of different perspectives outside of just basic level accounting. And he used to show us, compounding and, how much your money could compound and suggest like play around with a compounding calculator sometime. And I just remember like how fascinated I was just seeing like the growth numbers as the years tick on. And if you get this sort of return, how much this adds up to, and you deposit this much money in your account. And just like, that's what really got, in at that time, I'm like 18, 19 years old. So I'm like, oh my gosh, like this is a game of time, staying invested, being long-term. And it was just fascinating to me. And then I was kind of a little lost for a little bit there in terms of like what I was going to do, how my approach is going to be. So I'd watch CNBC and things like that. And I'd watch like Jim Cramer and stuff. But then one day I saw Warren Buffett, and like that changed everything for me. Like you're just hearing him talk and like learning a story. And then I would find YouTube clips. This is like, in the computer lab in like 2009, and just old clips that people would record of Buffett and, different things, speeches he would give to college students and stuff. And I just like, that really what set me on the right track to kind of being a long-term investor. I started out as just value and dividend stocks only. If it was over a 20 forward P, don't talk to me. Like it's got to be super low PE.
Yeah.
It's got to be, my first investments were simplest businesses like Walgreens, Walmart, Conagra Foods, Kimberly-Clark, like some of these sorts of companies back in those days. But anyway, so that's really how my journey started. And it was just, a fascinating time. The bad thing back then, the youngins you guys don't get this, okay? But back then, 1995 per trade you did. 1995 every time you bought and sold a stock. And for me, I'm investing a few $100 a time. So it's like, oh my gosh, like it's a $20 commission to buy $300 worth of stocks. Like this is ridiculous. So, but thank goodness, very shortly after they brought it down to $9.95. Then they brought it down to $4.95. I'm talking about Fidelity Investments, and then probably 5-7 years ago they went to $0 because of Robinhood. So thank you, Robinhood, for that. But and we can all thank Robinhood. I know Robinhood always gets a lot of hate, but Robinhood definitely changed the game when it came to $0. But yeah, that's my journey. And then just got into some stocks over time that really changed the game for me. Trinity Industries was a company. This was a company that was a rail car operator. And what I saw was there was this big fracking boom going on in like North Dakota, kind of like South Dakota region. And I was like, oh my gosh, you got to transport all this oil around and whatnot. And so Trinity Industry made the rail cars, that are specifically for that industry. And so, I just was like, this is going to be a booming industry for a long time to go in the future. And Trinity Industry stock just was a beast. And so I capitalized on that. Monster Beverage was one of my first growth stocks. That
killer company.
Yeah, and I got that one because I worked at Quick Trip as a overnight assistant manager. I got a job there end of 2010, and all these landscapers and guys would come in, buy 2 monsters a time. And I'm like, back then I wasn't really familiar with Monster, and I started looking in the company. I found it was a public company. And I remember when I bought Monster, the forward P on it was probably either high 20s or low 30s, I think. And for me, that was like really risky because,
Yeah.
like my mindset is like, I want a forward P of 10, 15, something low. And so to pay up for a stock like that, that's what kind of was like my gateway drug of like getting into growth stock investing. And then Cabela's was a phenomenal one for me. Cabela's,
Okay.
which is the outdoor store, they went through a massive kind of boom that just, since the time I got in that stock, it just went up in almost a straight line. It was a beautiful, beautiful thing. They were expanding stores. There was a huge gun boom, an ammo boom that went on, specifically around this like 2012, 2013. It was just like mayhem. You'd go into the gun section at Cabela's in those days, and it was just jam packed. It was like a can of sardines. Everybody was afraid the government was going to stop everybody from buying guns, and there was that worries. And yeah, so anyways, that's kind of some of my early day journeys, and some fun ones nonetheless. So.
And so those couple examples or instances where you probably saw really tremendous gains, that kind of changed your perspective on your whole approach to investing. That's kind of what sparked the evolution from being a strictly dividend investor, low PE, to realizing there may be more beyond that. Is that kind of what happened?
Yeah, and that kind of led me to the thought process of it's more than just what did the company earn last year. And you rather
Yeah.
really start running projections on stocks and trying to figure out, okay, where's this company's revenues likely headed next year? What about the following year? What about the following year? In order to try to project out that and then try to figure out, okay, what's the realistic gross margins for this company? What's the realistic operating margins? What's the realistic net income? You got to really go down that rabbit hole deep into that company and really. And still, you're going to be wrong sometimes. So it's never like it's a foolproof 100%. You're going to be right. You're always going to miss some, here and there. But yeah, and then learning to run projections on stocks and then trying to figure out, okay, if I'm paying a 30 forward P for a stock, it looks maybe expensive because the market trades at, let's say, a 20 or 15 or whatever, but it might be a steal deal if this company is going to eat up the profitability over the next few years. And next thing you know, actually the following year, it's actually trading at a 20 forward P based upon next year numbers, or 12 on the following year or something like that. And that's where you get into this kind of like thought process of like, oh, like Amazon's a perfect example. I remember looking at Amazon like 2010, 2011 and being like, I love this company. Like, I think, everybody's going to be ordering packages in the future. And this AWS thing that seems interesting, but I couldn't buy Amazon because the PE, it was so dang high. But if I knew at that time to be able to run projections and things like that, I would have been able to easily buy Amazon stocks. I would have been like, oh, they're gonna eat this up. They're gonna get to this sort of EPS in future years and things like that. So that's a hard process to do, and that's one of the more complicated things.
Yeah.
It's much better to start as a value dividend investor because it's so much easier of a game. You can look at
Right.
Coca-Cola and it's got a certain amount of income over the last many years. You can figure out where it's likely going to grow next year. You can look at the forward P and you can say, yeah, this is a fair valuation. I'm paying as a fair price or not. So some of those companies are much better for beginners. Beginners, sometimes these folks like to get in like crazy stocks, and it's like, I'm just saying, like, you're not at the level yet to really understand how to run valuations out for future years on companies and all those sorts of things. So,
And
what
that's
you're doing is really good for beginners, in my opinion. Really, really good.
Oh, well, thank you, man. It's some of the crazy stuff that people get into when first starting out, which, by the way, is something I fell victim to as well. It's a combination, I think, number one, of human psychology. People just want explosive gains. They want overnight things. Understandable, especially in today's day and age where everything's so immediate. But also, it's probably partly as a result of, which this is a good and maybe a not so good thing, just partly a result of there just being so much information out there, so many people talking about stocks, and which could be good because it helps build awareness and can get people into investing. But if you watch the wrong video or listen to the wrong podcast or read the wrong article, it could put you down a pretty bad direction that could ruin investing for you potentially. So yeah, man, it's like I said, it's kind of the double-edged sword of being an investor today. It's good because we've got access to so much information, like you were saying earlier, commission-free trading. Now there's really no barrier to entry to getting in and starting to do this, which, I firmly believe that investing in whatever capacity, whether it's real estate or stocks or however which way you want to do it, is something that everyone has to do. As the old Warren Buffett quote goes, if you don't find a way to make money in your sleep, you're going to work until you die, and no one wants to do that. So you better get started soon and figure it out. But also, to your point, man, you were just kind of talking about valuing stocks and how much, I guess, easier it is to take this sort of approach, especially if you're a beginner. You know, it is very straightforward. We can do certain things like discounted cash flow calculations, just looking at the projected cash flows based on what's already been done. Because a lot of these companies are more mature, it's a bit more straightforward. It's a bit more predictable at times, depending on the company. And so it's easy to come up with some sort of intrinsic value. But man, when you get into the territory that you're in, when you're maybe dealing with so many different hypotheticals and there's so many ways that things can go wrong, it's not for the faint of heart, for sure. And as they say, this ain't no jokas.
Yeah, say no jokers. You're gonna get your flapjacks flipped one way or another. They're gonna get flipped on the floor or up in the air. You just don't know which. Oh man, but yeah, it is. And that's where diversity really comes into play, right? Because some people, they like to put all their eggs in one basket. For me, let's say I'm wrong about a growth stock. It's not the end of the world for me. I'm going to be wrong about stocks. Like, I go into every investment I ever make, right, knowing that there's a potential that I'm going to have to sell that stock for a loss someday. It is a realistic potential. And so as long as you're diversified, you can make it through those bad stocks. That's how I make it through bear markets. I've made it through several bear markets now at this point in time. I've made it through several bad stocks that I didn't see them going so bad, and they went super bad, and it's like, oh my gosh. Diversity is so important. It is so important. And that's one of the things I preach so much, because a lot of people just risk too much in one or two stocks. And it's great when it works, but the problem is all you need to be wrong is one time. If you're super heavy in a stock and it's devastating your portfolio, it's devastating your net worth, and then it takes years to climb back to just where you used to be. Never mind, where you're trying to go. So that's one thing that's probably not talked about enough.
No, absolutely. And this is actually a pretty highly contested topic, at least here in the dividend investing community. One big question that a lot of people who watch my videos have is, like, how many stocks should I be invested in? And I mean, the answer is obviously it depends. And this is something I've been trying to think on more. I mean, for the beginner investor, there's always ETFs and mutual funds and more passive ways to invest, which I want to get your thoughts on in just a moment. But something I've been thinking about more lately is that question, how many stocks is too many? I mean, number one, how many stocks, if you're going the individual stock route, how many can you keep track of? How many quarterly earnings calls can you listen to? How many financial statements can you keep up with? How much news can you handle on a daily basis or a weekly or monthly? That's certainly a component to it. But even so, it depends what kind of stocks you're investing in. If you're going to invest in ones that are maybe a bit more speculative, maybe their cash flows are not as certain, well, kind of like you're saying, maybe you need to be spread out a bit more. But with those, there may be some more variance in the returns, either good or bad, from the rest of the market. And so, kind of like you were saying, if you really lose out on one, if you're highly concentrated into one or a few particular holdings with that style of investing, you might get burned pretty bad. I mean, the potential for returns are pretty great too, but it could go the opposite way that you're hoping. And so in that instance, probably makes sense to cast a wider net. And even doing so, because the potential for extreme returns is there, it might take one stock to really make a huge difference in your portfolio, right? Like, has that been the case for you? I know you have, dude, you've got a few positions that have just gone insane, absolutely insane. Like your Tesla, I can't even fathom those returns. But would you say that's been the case, where it's been one or two? I know you're up on quite a few stocks, but it's been those one or two that have generated those like out in space returns that have made the difference for your portfolio?
Yeah, 100%. Yeah, you don't need very many stocks to become, let's call it grand slams. All you need is a few, and it's like changes your life completely and changes your portfolio trajectory completely. The great thing about stocks is, the worst case scenario, you buy a stock and literally they go bankrupt. It goes to zero, you sell for 100% loss, right? Worst case scenario, as long as you're not on margin or something like that, right?
Right.
The great news with stocks is you pick a great stock. I mean, it can 3x, 5x, 10x, 20x, 30x, 50x, 100x. Like, there's no limit to how much money you can make. So if you put $10,000 in this stock, it goes to zero, and you put 10,000 in here and it goes to 50K. Yeah, you're still doing let's call it very, very well for yourself, right? So I think that's one of the things that's probably missed when it comes to investing, because people think they have a false assumption that you need to win every stock. You need to make money every stock. You can never lose money. Just not how math works. And I just wish people spent a little more time in the math classroom than whatever they spend their time on TikTok or whatever, because, you just run the numbers and you see, like, if you just have a few game changers, like the public count, for instance, 2 game changing stocks, ELF in Tesla, like ELF sitting on, I don't know, 1,600% gains or something. And obviously Tesla's sitting on some massive gains. And so those are just game changers that just level you up, and just like, they almost wash away anything you kind of do that's like, something that didn't go the right way. Let's just put it that way. And so, but those sorts of opportunities are harder to come by in the market. It's not like every stock's a 10x opportunity. So, you're going to miss some when you're trying to go after those stocks. And that's a level of variance you have to get used to. And that's tough for some folks to mentally get there, realizing, damn, like this, I'm taking a risk here, and this one might not hit, and I might sell for 50% loss, 70%, 90% loss, or something like that, right? Mm-hmm. So, yeah, it's definitely, like you said, not for the faint of heart. It's definitely a challenge. So, but investing
that's like level 20 stuff for sure. Yeah, you're going boss mode when you get to that level. And then on the other, just sticking to diversification, on the other side of that, if you are going more stable companies with more predictable cash flows, then maybe it could make sense to have a smaller batch of stocks. Maybe you could, instead of having 30 to 40, maybe you only need 15 to 20 if you're going the individual stock route. But then again, there's always the ETF route. What do you think about a more passive approach to investing? Because you're a very active investor. You pick all of your stocks. From what I know, I don't think you have any mutual funds or anything like that, right? You're 100% individual stocks?
Yep.
So,
never been an index fund guy, never mutual funds. Go ahead.
So, I mean, what do you think about a passive approach to investing? Because there's been others like yourself who are strictly active investors, like Peter Lynch. I think he called passive investing, this was a couple of years ago, called it a mistake. Do you have any thoughts on passive investing, or what do you think about all that?
So, passive investing still comes with risk. A lot of people look at it as like a risk-free proposition, which is just not true. Like, there's still significant risk in even Stanley Druckenmiller was talking about like a stagnation in the market for this decade, right? Where you don't get any returns. And, that would be pretty devastating if you're only in index funds, right? But I think a lot of it comes down to, do you enjoy and like to put in the work toward investing? Like, I love listening to conference calls. I love putting in the work and researching stocks and keeping up with the news and things like that. To me, that's fun.
Yeah.
It's not fun for everybody. It's very similar to like entrepreneurship, right? Some people like to, work for a company and 9 to 5, and, as soon as it's 5 o'clock, they're out. Don't talk to me. Don't call me. That's fine, right? Other people are like, no, I'd rather be on all the time. I want to be an entrepreneur. I want to run my own business, run my own show. And so it's a very similar phenomenon in the stock market, where most people are kind of like the 9 to 5 employees. They don't want to have to research. They don't think that's fun. They think that's lame, and they don't want to do all that, right? And so for those folks, like, index funds is perfectly fine, right? But for some of us, that's just not good enough. Like, we want to put in the work. We love this. We enjoy it. We enjoy, having our money in the stocks that we believe in for the next 5, 10 years, whatever. And we'd rather die on our sword than die on somebody else's. And we'd rather live on our sword and bet on ourselves rather than bet on somebody else. So, yeah, I think that's what it really comes down to. And there's definitely a lot of people that like to pick individual stocks and do their own research and invest their own portfolios, and that's great. And that's most of the people that watch, like, my channel, for instance, and I'm sure most of the people that watch your channel. And then there's a batch of folks that they don't care about that, and that's perfectly fine. This world's got many opportunities for many different folks. So,
Absolutely, man. Definitely more than one way to skin the cat. I remember, when I came into investing with no experience whatsoever. I had no background in finance. I did not know how to read an income statement or a balance sheet or anything like that. I was totally lost when I first got into this stuff. And I when I first got started, I went for better or for worse. I went all into all individual stocks, and kind of have learned as I've gone along. Obviously, still have so much to learn, but have certainly come a long way. But it's like you said, man. It's for some people, they look at all this stuff that comes with investing in individual stocks and think that's too much work. I don't have the time for that. But I don't know. For guys like us, that's where the fun is. And if you would have told me like 5 years ago that I would be this interested in looking at all this stuff and thinking about all this stuff, and furthermore talking about it to the world, I would have thought you were on drugs or something. I just would not have seen it in any reality. And it's kind of interesting. Like I think of my portfolio and the stocks that I buy and own almost as like an extension of you and the way that you think about the world and what you think is going to happen. And I think, like I said, that's where the fun is. It's fun to think about all this stuff and try and think about how these things are going to play out and see if you're right or wrong. But yeah, I guess it's certainly not for everyone, huh?
Yeah, and no, that's a phenomenal point. Well put by you there.
Thank you.
You know, yeah, for me, it's so much fun. It is so much fun. And I just love like the control of controlling my own money and those sorts of things. I just always like really enjoyed that. It gives you a different outlook on life. I think it really does. When you really go down that rabbit hole and you look at the world differently, like you never
Yeah.
realize like how until you really get into stock market investing, like looking into companies and this whole business landscape and investing, you don't realize how like ignorant you were before. And some say ignorance is bliss, because I still remember like, when I was starting to get into stuff, 18, 19, 20 years old, just like starting to look at everything in the world differently from a different lens, and just understanding like, oh, why that company over there is having a sale on that product. And oh, I see why they're discounting that over there. And wow, they must be getting a really good margin over here. And you start looking at the world totally differently than any average person, and you go to anywhere, you go to, the strip at Vegas, right? And you can be
Yeah.
like, man, this is so overpriced. Like they got to be making crazy money on this. And then you're like, well, they're probably paying a lot of rent for this place because it's right on the strip. And you're like, oh, I wonder what these employees are getting for, like, you look at the world totally different, and it's never the same after that.
Yeah.
So, but anyway, so, once again, it's not for everybody, but for the ones that, really enjoy it, the returns are out there for you to get. And, everything's cumulative. That's the best part. I don't think that gets talked about enough. We talk about the compounding of money. There's also the compounding of knowledge. I mean, if you're doing this for 10, 20, 30, 40 years, I mean, my gosh, imagine how much more intelligent you're going to be in 20 years from now than you are today. You're going to look back at yourself and be like, oh gosh, I didn't know anything about stocks back then, compared to what you know 10 years from now and 20 years from now, and those sorts of things. So it doesn't mean you're not going to make mistakes, because even an experienced investor makes mistakes, right? Warren Buffett still makes mistakes. Like he's been doing this for a million years. So, but anyway, so that's kind of my thoughts on that. But it's fun. I enjoy it as much now as ever, and it's so much easier, man. Conference calls. There's a conference call app.
Yeah.
You literally
Yeah,
pull
dude.
it up. Yeah, and literally, boom, any conference call is playing on your phone within 5-10 seconds. Like that's crazy, man. It's beautiful.
So are you using the Quarter app, or what are you using to listen to your calls?
Oh gosh, it's some blue app. I don't even know the name of it. I think it's called like the conference calls app. I used to have
Okay.
an app that you could listen to conference calls on. It used to be called Hungry Bowl.
Right,
And
I remember that.
yeah, we used to have a feature where you could listen to all the different companies' conference calls on that, and that was pretty cool. But yeah, now it's some blue app. I think it's called the conference calls app or something like that. And yeah, I go on it and boom, right away, like every conference calls up within like usually 1 to 2 hours, and it's so cool, man. So what a time! What a time to be an investor.
Dude, I couldn't agree more. So, for the brand new investor who's maybe considering going the individual route, they like what we've been talking about. They like dying on your own sword, making your own choices, learning about the world, and applying that to investing. For someone who is interested in that and wants to learn more about picking individual stocks, where do you think is the best place to start? What's like the most important thing that individual should know or start learning?
Oh man, that's tough, because there's so there's so many things. Um, First, you got to ask yourself, I think, like, what type of person do you want to be in the market? Because you have a lot of different market participants. You have a lot of different options. You could be a trader. somebody trying to get in and out of stocks. That's certainly not what I do, and I don't think that's what you do, Ryne. But some people like
No.
to trade in and out of stocks. They're trying to get this penny here and penny there, and swing these stocks and things like that. And they really look at stocks, instead of looking at it as I'm buying an underlying business, I'm buying an actual business here. They're looking more of it as I'm just buying this ticker that I think is going to go up or down or whatever, right? So you got to ask yourself, are you that person? If you're not that person, okay, good. Thumbs up for you. Okay. So then you got to ask yourself, like, how long in duration are you thinking, right? I'm usually trying to think more in 3 to 5 year increments. That's what I can kind of realistically see, in my opinion, is like 3 to 5 years out. Or are you more like a Buffett type investor that you're trying to think like, I'm going to hold this stock until it go to the grave, man. I'm going to hold it forever. Like this is, and so you got to ask yourself, where are you trying to go from there? And from there, it's really about, learning the psychology of money first. I think that's really important. Like understanding compounding, how it works, understanding risk reward, right? It was interesting. A few years ago, I got kind of into playing poker, living here in Vegas and just wanted to kind of learn more about poker. And it was interesting learning, kind of how to play high-end poker, at a high level, because you realize that so much about like investing, like you realize, oh my gosh, like game theory and all this stuff and taking the risk and when to take an appropriate risk and things like that. Man, it's fascinating. But that's a huge component, is knowing when to take risk, when not to take risk, when is it very attractive. And the thing I always like to think about, what are the chances I double my money on the stock over the coming years versus lose 50%? So that's something. And there's a lot of phenomenal books out there. The Intelligent Investor was one I really enjoyed. It's not a book for everybody, but I certainly really enjoyed that book. There's the little book of Common Sense Investing is a pretty good book. There's a lot of stock market for beginners videos out there. I used to put out those type of videos years ago. They can definitely get you on the right track. But you got to learn the financials. Income statement, balance sheet, especially. Cash flow can be helpful too, but especially income statement and balance sheet. Learn those, not super complicated. If you're a fairly high IQ person, you can learn income statement and balance sheet in a matter of a few days. If you're maybe a little slower, maybe it takes you a week or 2 weeks to learn it, but I can tell you it's not rocket science. And so, because if you don't know financials, then it's really hard to make any judgments on your investments. And then just really get into the business aspects of like understanding what made previous companies successful. It was something I really got immersed into in my first many years of like learning about these, what made this company successful, what products or services made them click, like what was their approach to the market, and just understanding how giant corporations were built over time. Because then you can kind of identify patterns in seeing future companies that, I can see how this company can grow into this and this and this, because it's been a lot of examples over time since the business has been around for a long time of like how this company can become that next big giant. So, but anyways, that's kind of the starter, and then you can kind of go from there.
Yeah. So these days, what does your stock research process look like? Like, how do you go about picking stocks? And I know that's probably a very complicated question, but Spark Notes version, I guess.
Yeah. I mean, first the spark comes of like, how did it even hit me? Did I see it on CNBC or Bloomberg, or did I, a friend tell me it, or somebody in the private stock group Discord chat message about it, or there's a million different ways. Did I see a YouTube video about somebody talking about the stock? So seeking alpha, like different places, like the spark comes. Then it's about just trying to figure out, okay, do I know what this business model actually does? If I don't know what the business model does, then I'll go to the 10K, kind of, start reading about the annual report, read about the business model. How does this work? Like, how do they make their money? All those sorts of things. And then from there, look at the financial statements, try to think about the business model. Like, is this a business model I believe in for the coming years? Do I need to do more research on this industry? And that's a big part that you get into circle of competence, which is a big Warren Buffett thing, because there's a lot of stocks in the market. It's a lot of industries that you're not going to know crap about, that you're going to need to research that industry for maybe months or years before you really can wrap your head around it. A good example for me is the semiconductor industry. I mean, the semiconductor industry it took me like at least a year of research on semiconductor stocks to really start to understand what was going on there. This is back in like 2013, probably 2012, 2013, 2014, understanding companies like Cirrus Logic and Skyworks Solutions and Qualcomm and all those sorts of companies, and why they matter, and what sorts of prices they can get on their chips and command for those, and everything like that. So anyways, that's I got to figure out the industry. Do I know the industry well? If I don't, then I got to go down the rabbit hole in industry. And then from there, it's really about looking at the current valuation, trailing 12-month P, forward P, where do I think this company's going over time, and kind of going through that process and then trying to figure out, am I getting a good deal on the stock or not? And there's a lot of stocks that's the other problem. There's so many stocks at a given moment that are usually going to be a good deal that then you got to figure out, is it worth me buying the stock? Let's say you think it's a pretty fair valuation. Is it worth buying that stock versus putting your money in this other stock over here? Because all these stocks are trying to steal your money. Every single person in the world has a finite amount of money. Every single person, even the rich people have a finite amount of money. So of that finite amount of money, where do you put it? And that's another difficult decision. Does it go over here to this stock, this stock, this stock? And then are you too invested into one stock? So maybe you have to invest it somewhere else because you're already over invested in the stock, right? Yeah.
On that note, like, I mean, how do you determine when is enough? Like, how do you determine that you have enough invested into one particular stock? Like in one of your videos the other day, you were talking, I think, about Fubo, and you said, here, where I'm at now, I don't want to buy anymore. But how do you know when you've reached that point where you've got a full position, even if it's maybe at an attractive valuation or something, I can't add more? Like, when is enough?
A lot of times it's a gut feeling of like, you take everything into account that is like factual, like, the numbers into account and the current valuation and the risk and what are the realistic possibilities this goes really bad, and how bad does bad look? Does it look like zero, or does it look like, the stock goes down 50% and things like that? And then at the end of the day, it comes down to a gut decision based upon all the available information you take into account. At the end of the day, it's a gut decision, no different than buying a stock, right? It's like you take everything into account, and then it's like, okay, it's that gut decision of like, I feel comfortable investing in the stock. So the riskier the stock, the less money you can really allocate toward that position, I guess you can say. And the more of like a sure thing it is, and of course there's always risk, and it is never really a sure thing in the markets, but the closer to a sure thing, the more I can allocate toward a stock. So a good example of that is Meta last year. There was one day when I put like $77,000 in Meta in like a 24-hour span, which was crazy. For me, that's a crazy amount of money to invest in a day or whatever, right? But the risk reward at that time was so ridiculous on Meta that I'm like, I got to take advantage of this. So the risk reward was there. And why was it so attractive? The valuation was super low. I thought about what their profitability has been in the past, what it can be in the future, what their balance sheet's looking like. The chances that stock goes down much more versus up substantially, and it just made sense. But at the end of the day, you take everything into account, and it still comes down to that gut decision of like, okay, I'm going to go ahead and do this. So the less risky, the more I can allocate toward it. The more risky, I guess you can say, the smaller the position has to be, because if you're wrong, it's a painful loss, obviously. So
yeah, dude. So on the topic of gut decisions, you made a certainly an unplanned and maybe an unexpected move in your dividend portfolio today. What happened?
Yeah, Tapestry has been a pillar in the dividend account for several years now, and been a tremendous stock, great gainer in terms of money, and it's been one that's thrown us a lot of dividend money off over time as well. But Tapestry made this announcement today that they're going to buy another company named Capri Holdings, which owns Versace, Jimmy Choo, and Michael Kors. And this deal is going to be like, they're going to have to probably go $8 billion in debt or so for to capture this deal essentially. And it's just, I think it's a pretty questionable move that's going to be messy for years to go in the future. And I just looked at the stock and I said, this is a far riskier company now moving forward. I mean, if we're talking about this level of debt with interest rates where they're at, it's no longer the stock I was in before that had $600 million plus of cash, and they had about $1.6 billion of long-term debt and had a balance sheet that's just, fine and dandy. Now we're talking about a company that's cash levels are going to go down, and their debt is to numbers that you can't even really fathom compared to previous. And so that makes it a very risky proposition. And so unfortunately, I cut that one loose today, man. And those are tough decisions, and that's the one thing that's kind of a negative when it comes to actively managing your own portfolio, is like you have to make some of those tough decisions in real time. And that you never planned on making. I never thought like, oh, Tapestry's going to buy out Capri for $8.5 billion. Like that wasn't even in my thought process. And yet it happens. It comes out of nowhere. And that's sometimes in the markets, unexpected things are going to happen that you never expected. Ronan was a good example of that, right? Where it's just like, what? Oh, we're going to all of a sudden shut down the worldwide economy? Like, what? Are you kidding me? Like, this is insane. So anyways, yeah, I had to make that tough decision today with Tapestry, and it is what it is.
Yeah. So what did you reinvest those funds into?
Yeah, so since I was in the dividend portfolio, it was all dividend stocks. Let's see, I bought a Foot Locker. I bought Wynn Resorts with that, which their business is just in a tremendous place right now. Foot
I
Locker is
love
more
the
of
win.
yeah. I mean, the creme de la creme. Macau's just throwing up phenomenal numbers again. They're pretty much back to 2019 type levels, prior to Rona. Obviously, Vegas, we got a lot of excitement coming with F1.
And China's
with
not even
Super
fully
Bowl.
opened up. China's just kind of coming out of their thing too. So maybe some more growth for Macau from here.
Yeah. Macau should be a growth engine for many years to go in the future for Wynn. So that's a beautiful situation. And anyways, a Foot Locker bought that one. They got a new CEO there, Mary Dillon, who came over from Ulta Beauty, did a phenomenal job from 2013 to 2021 in regards to Ulta Beauty, and grew that company like a beast. So she should be able to, reorganize Foot Locker in a good place, and put them on a great trajectory over the next few years. Big dividend yield on that one. That's like a 6% type yield.
Hmm.
I bought, let's see, what else did I buy today? There was like four other stocks I bought in that portfolio overall.
Little Cheesecake
Gosh, man.
Factory, maybe.
Cheesecake Factory, thank you. Cheesecake Factory, that was a bigger buy for me. Texas Roadhouse, which is,
Beast.
no debt. Yeah, such a great company, so phenomenally run, and no debt on the balance sheet. Like that's just almost unheard of in the restaurant industry. So yeah,
Yeah.
Target was a big buy for me. Target's
Mm.
a sneaky dividend stock. It's kind of going under the radar right now. They went through their drama a few months ago. That will all pass. Target will be just fine. 3.3% yield on that one, and that's one of those that's just especially when dividend stocks. I like to think about stocks that I can buy, and if they go down 10, 20%, whatever, I can buy the dip on, and it's not even like stressful. It's
Yeah.
just like, give me more shares, load up the filing cabinet. It's not like these are questionable companies. Nike, I bought some Nike here today. I don't love the valuation on Nike, but that's one of those I'm like, please go down. I'd love to buy a lot of shares for a much cheaper price than it's at right now.
Yeah,
Those are the sorts of stocks.
Nike's got some pretty solid growth though. Like really,
Yeah.
from what I remember, really solid growth in sales, really solid profit growth as well. That company just seems to always be firing at all cylinders.
Yeah. You have to pay up, unfortunately,
Mm.
for companies that are really well run. And Nike, obviously, one of the most well run companies for the past 30, 40 years, really. And yeah, you got to pay up. No different than Apple. I don't
Yep.
love Apple's valuation, but Apple's one of those companies. It's just so well run. Their products are so sticky. Somebody's iPhone breaks, they go buy another iPhone. So, anyways, that's where I kind of distributed that capital around. And yeah. But yeah, selling decisions are harder decisions than buys. I don't think a lot of people that are newer to the market understand that. Buying decisions are cake because if you do enough research, you're going to be able to find plenty of stocks you love that are very attractive valuations. The selling decision is tough because it's like, it's like you're breaking up with that stock, and it's just like, it's a whole process. So
Yeah. I just went through that in my portfolio with 3M. I just put out a video on it last weekend.
okay,
And 3M, obviously a very iconic, legendary company. It's been around for such a long time, and their products are in every industry imaginable. I think I've got some post-it notes like somewhere in there. And so, very iconic company. It was one of the first ones that I bought when I first got into dividend investing, and at the time, just not knowing anything, I was like, yeah, Dividend King. It's been growing the dividend for 65 years, which I thought meant it was impervious to like anything.
hmm
Nice yield. I know post-it notes. I know command strips. I know Scotch tape. So what's not to love? And so I bought into that thinking I was going to hold on to it forever. But they've been going through a pretty tough time. I mean, they've got some pretty big litigations facing them right now that are creating a large amount of uncertainty. At best, and at worst, will carry on for a number of years. And could potentially result in the dividend no longer being there, which for someone like myself is kind of a big deal. And so, like you said, it's a really tough decision, but I ultimately decided, this company, as iconic as it is, it really doesn't have a lot of growth. It's a huge company, so it's not been a huge grower. I'm down a decent amount, which was very unfortunate. Um, and I think I can redeploy into other things that I can feel a bit better about, and I think will offer more growth over time. So that's what I did. And you know, in doing so and putting yourself out there, you get so many opinions. Some in support of the move, some who think that you are just like an absolute cretin, which may be true. I don't know. We'll see. But I got to say, it feels, as unfortunate as it is to sell it, it does feel good. It does so far feel like the right decision. So it's a bit bittersweet. And the worst part is being down. But if I'm not mistaken, like with your Tapestry sell, you were up quite a bit with that company, right?
Correct. Yeah, yeah. Tapestry up substantially. Now, a few things to add there in regards to kind of your 3M sell and whatnot. Sometimes when you've been battered and bruised with a stock, the best feeling in the world is to cut it loose, and breathe new fresh air. Because sometimes, with some of these stocks, you just are going through it, man. And it's just like, oh, this is so stressful holding the stock. And it seems like it's just bad news after bad news. And so, yeah, sometimes it's the biggest breath of fresh air when you can finally find it. As somebody that's sold plenty of stocks over the years for losses, right? I've been doing this for 15 years. Like, you do it for 15 years, you're going to sell plenty of stocks for losses. It's always the best feeling after you cut it loose and you just finally move on. It's like a really bad relationship you get in with a boyfriend or girlfriend, and then you finally break up with them, and it's like, oh my gosh, you're like, the sun shines differently than after that or something, man. It's beautiful. So, and in regards to 3M, because a lot of people ask me about that one, and I just have stayed away because of legal stuff. I mean, they had the worst acquisition, unfortunately, in the history of mankind. I don't think there's ever been a worse acquisition than buying, they didn't even pay that much money for that earplug company. And, they're going to have lost maybe 100x, if not more than that, in terms of what they spent on that company versus what all that litigation is going to cost them. I mean, just unfortunate. So, and then they went through some other litigation on some other stuff as well. So it just seems like a company plagued by crap. And there's too many opportunities in the market to have to mess around with companies that just seem to, screw up time and time again. Boeing's another good example. No hate to anybody that owns Boeing stock, okay? Boeing's another good example of a great historical company that I've stayed away from over the years because it's just every time Boeing seems like it's getting back on the right tracks, they screw up something. And it's just like, suddenly they need to delay this plane and this and that. And it's just like every time with Boeing, man. And so there's some of those companies out there that, they're so tempting. It's like they make a lot of money. Their dividend yields are pretty good. And they're super famous companies like a 3M or a Boeing or things like that. But they just find a way to somehow screw up again and again and again. And it's just like there's thousands of stocks in the stock market, and it's not worth being in companies that continually seem to screw up every other year or every year. And you're just like, dude, this is too stressful. Like, yeah, too many stocks out there.
And with companies like that, like the 3Ms, being such a big company, they just kind of have a target on their back too, in a way. And there's others just as big with a similar type of risk, that litigation risk, like Johnson & Johnson. We're seeing it in the telecom sector right now with AT&T and Verizon. There's just these big companies these days just have huge targets on their back. And that's, as individual stock investors, once considering, putting your money into these otherwise pretty sleep well at night companies, that's something you have to take into account in your valuation process and your research, and maybe want to give yourself a little bit more margin of safety when accounting for those things. And that was a huge lesson for me. That, number one, it was a huge lesson. But also, number two, like I said with 3M, it was one of the first stocks I bought, and I bought at a time where I really had no idea what I was doing and what to look for. And so when it came to, I just realized I didn't have a strong investment thesis with this company to begin with. And moving forward, like that's, and I know this by now, that's a non-negotiable. You have to know why you're buying or selling a company. You've got to know. You've got to know your reasoning. You got to know your why. Your reasoning for doing X, Y, or Z. It's just so important.
Yeah, and in regards to 3M, I mean, it was devastating when they couldn't just basically do bankruptcy. When the judge ruled they couldn't just bankrupt that one unit, right? And they had to obviously, it fell back on the parent company of 3M. And that gets into a lot of dirty politics and stuff like that of if you can help out the right politicians who have the right judges in your pocket, maybe that's ruled differently. Um, and so, not a lot of people really want to go down that rabbit hole. It's a dark rabbit hole, but it exists there for reasons. And the companies that are the best are the ones that got the politicians in their back pocket, because they're able to not have nearly as much scrutiny when they need certain things to get through. They get those certain things through, and sometimes these old bureaucratic companies, they don't have that DNA of kind of that dirty work you got to do to make all these connections and stuff like that. That sometimes a younger, scrappier company might have. So, anyways, that's a dirty rabbit hole that we don't need to go down. But yeah.
So I got a few last kind of questions for you, a few fun ones. But before I get to those, do you ever see yourself transitioning away from, I guess, what you're doing now, which I know you have a balance of kind of everything, but maybe making your bread and butter the more hyper growth potential, I guess maybe smaller cap companies, and looking for those explosive returns? Do you ever see yourself transitioning more into the dividend portfolio and at some point maybe using that cash flow or taking that approach? Do you get what I mean?
Yeah. No, for me, I just really like where I'm at in terms of having that combo of growth stocks, value stocks, dividend stocks. I, don't really see that approach changing, maybe forever, just to be quite frank, because it just seems like the perfect fit for me. And it
Yeah.
just makes me a very well-rounded investor, not one-dimensional. And so for me, I don't see that ever changing unless there's ever a day when I don't want to put in the work. That could maybe change things for me. But yeah, it's for me, everything in life is like trying to become, a master of that mastery. And for me, like, you really want to become somebody that's amazing. You've got to understand so many different disciplines, like how to take advantage of those. Even like I think about Buffett, right? Buffett's obviously done so well in his life and, created a net worth. It's just amazing. But just imagine if that man could have just considered some growth stocks over time, like just a few. You know what I mean? He didn't need to nail them all, like just a few. Like imagine where his net worth would be at. And of course, it's all is what it is. Man's 90 something years old now, so I don't think it really matters that much. But for me, it's about the game of money,
Yeah.
and trying to master that game and become the best you can at it. And I feel like to be a well-rounded investor, you really got to understand all these disciplines. That even gets into hedging and some of those more advanced strategies, and what are the right companies to hedge against given different economic cycles that you might be in, and what stage you're in that economic cycle. And so, oh man, to me it's fun though. To me it's fun. Not everybody, but to me it's a lot of fun. I bought a new book here recently. I believe the author is Howard Marks. I'm on like page
Yeah.
40 something of it. It goes into market cycles and understanding where kind of you're at in a cycle and how these things ebb and flow, and how it all works. And just like, so for me, I'm always learning about new industries, in sectors and companies, and just it's just to me it's fun, man. And so yeah, but in terms of my overall approach, GVD, I don't see that changing. I think that's going to be a lifer.
Yeah, that makes sense, man. It scratches that itch for you, so that's good that you found that. Okay, last few questions. These ones are kind of maybe a bit more rapid fire. Number one, what do you think is the most slept on company right now? The most underdog, underrated company,
PayPal.
and why?
Yeah, definitely PayPal right now, at the moment as of recording this, August, whatever it is, of 2023. Definitely PayPal. Stocks trading a little above $60 right now, and just most attractive risk reward I've seen in the market since Meta back in Q4 of 2022, in terms of just like growth for years. 4P on it's like 11 or something silly right now. Like, it's just it's valued like it's a cheap dirt value stock, but yet it's still actually a growth stock. And so yeah, that's the most underrated stock in the market. As soon as you said that, PayPal came to mind. It's just, yeah, no question. Like that's the one right now. And there's other stocks out there. It's just that's the one that
Okay.
without question.
And what about the opposite of that? What's the most kind of overrated stock right now, and also why?
Hmm. Overrated stock, McDonald's. McDonald's most overrated stock. Them and Chipotle. Chipotle. I love Chipotle. Um,
Me
I'll,
too.
I'll go more with Chipotle than McDonald's. The problem with Chipotle, they've been putting up these insane comp store sales for, oh gosh, a while now. and they got this insane valuation they're sitting on right now. And if those numbers start slowing down, that valuation is going to get, um, as Elon Musk would play, it's going to get crushed like a souffle, okay, or something like that. Elon Musk says, and so yeah, Chipotle, great numbers, great company over time, but man, if there's such a risk of if things start to slow for their business model, that valuation is going to come down massively. And I also think McDonald's is actually a little bubblish territories. Their numbers have been extraordinary over time, but man, yeah, that one's trading really rich for being, kind of a played out old dividend dog, out there. So,
Okay, that's good. And McDonald's is a very popular one in the dividend investing community. Nice dividend payer, but is also known.
Did I say McDonald's? I meant McDougal's. McDougal's is the best.
Yeah, maybe that was the misunderstanding on my part. But okay, two more questions. The next one, we talk a lot about. I've heard you talk about a little bit. This is something that I talk about as well. Talk about in investing what you know, investing in, especially for beginners, investing in companies whose products you use. Like, I know you've got a few Teslas. You have a huge Tesla position. Maybe you're rocking that Elf Cosmetics moisturizer with hyaluronic acid. So you've got the Elf, and I actually have that. I actually really like it. You've got Cheesecake Factory. Maybe you've got a freezer full of that brown bread. That you just can't get enough of. But are there any companies out there whose products you use that you're a fan of, you stand by them, but you just can't get behind the stock? Are there any like that for you?
Oh gosh, it's funny you mentioned that because I just bought Nike for the first time in my life. Nike's one of those companies I've always, I've worn Nike my whole life and never really been able to buy the stock due to valuation concerns around it, right? So that's one that comes to mind. I think if I'm personally using the product, I'm more likely to be a buyer of the stock. But yeah, here and there, Disney's a stock that's been really highly debated, and I owned a little bit of Disney for just a bit there. And then I was like, nah, this is too much of a mess for me to mess with. And once again, it gets back in, there's too many great stocks out there to be messing with messes, and Disney's a mess. And so, never really been, super in Disney, and obviously as a sports fan, like ESPN's always been, and Disney owns ESPN, so that's a good example of that. But yeah, that's kind of a few that come to mind. I can't really think of too many others. That's probably about that.
That's fair. I think Disney's a really good one. There's so much to like about the company, but then when you look under the hood, it kind of tells a different story. So I totally get that. And then the last question, man, if you were to, if you had $100,000 to put into a stock, and I might know the answer based on what you just mentioned. If you had $100,000 to put into a stock right now and you couldn't sell it for 10 years, which stock would you pick?
Ooh, and I couldn't sell it for 10 years. Ooh,
Yeah.
that could change my outlook, because 10 years is a long time, man. A lot can change in 10 years.
What about 5? Let's narrow it down a little more.
Yeah, so 5, I would go PayPal. But 10, that's even a more intriguing question to me, because the stock that actually comes to mind when I think 10 is, can you guess it?
It's not McDougal. I know that. Maybe Tesla.
No, not Tesla.
Meta?
Meta's up there, but actually, I'm thinking Berkshire Hathaway.
Okay.
Berkshire Hathaway. Yeah.
That's a pretty safe answer.
10 years. Yeah, because buying Berkshire is almost like owning an index fund, with how many different businesses they own, how many different stocks. So I'm just like, yeah, if you couldn't touch it, because, obviously so much can change even in a 3-year span, never mind 5 years, 7 years, 10 years from now. Oh my gosh, so much can change. So, companies positioning, how those companies are valued, and just man, a lot can change. So, Berkshire actually might be the one if I had to buy for 10 years and couldn't touch the money.
Okay. Like I said, that's a pretty safe one. That's a good place to park your money for sure. But, Jeremy, man, that's about all I got for you. It's been awesome just being able to chat with you, man. I really appreciate you taking the time once again to do this with me. So thank you so much. And I'll be sure to put the links to all of your channels. I think 3 of them. You've got the main one, you've got your reaction channel, Jeremy Lefevbre Makes Money, and you've got the clips channel as well. Am I missing any?
Yeah, that's all of them that I'm actively posting on. But
Okay.
yeah, you don't need to link them all. Just so you know, it's like yeah, if you want to
Well,
find me, you can find me out there.
I've got the time, so I certainly will. But outside of that, outside of YouTube, if someone wants to get more involved with Jeremy, with you, where should they go? Where do you want people to go?
Yeah, you can go wherever, but if you enjoy my content and you ever want to say hi, say hello to me on Instagram. Actually, Financial Education Jeremy. Send me a DM. Try to get back to several people a day on there. So yeah, I always appreciate a follow and saying hello if you enjoy my content and whatnot. And make sure you subscribe to Ryne if you haven't already. Dividend Stock Master. Which Ryne, I want to ask you one question before we take off here. What
Sure.
is your what are your goals for your portfolio over the next 5 years? Like, where do you want to be? Like, what type of portfolio do you want to be looking at?
That's a really good question. In terms of portfolio size, I mean, overall, I'm just honestly, dude, I'm just trying to take it as it comes and do the best that I can. This is an infinite game, so there's never any end to this. I know that, but in the next 5 years, I would, and I don't see why this wouldn't happen. I would love to be at a six-figure portfolio. Right now, I'm at about 50,000, so we're halfway there. I'd love to do that. I'd love to be at a place where I'm maybe bringing in, $4,000 to $5,000 of annual dividend income. I think that'd be really cool. But outside of that, I'm really enjoying the journey. I'm really enjoying learning more about investing. I feel like I've just looking back on even just some of my old videos and the things I'm saying then. I think I've really come a long way, so I'm really appreciative of that, and I'm just hoping to keep on keeping on, man. And I'm just hoping for good things in the portfolio. No dividend cuts. Went through one of those this year. No more of that sort of stuff. So, yeah, dude, just keep on keeping on, I suppose. Kind of a lame answer, but that's the best one I got.
No, that's good. I love it, man. I love it. That's beautiful.
Yeah, well, thank you again, man. I do really appreciate it, and we'll wrap it up here.
Sweet. I appreciate it. Thanks to everybody for watching. Appreciate it.
Yeah, thank you guys. Anyway, guys, I hope you enjoyed listening to that conversation. If you want to learn more about the big sale that Jeremy just made in his dividend portfolio, then you can check it out in this next video right over here. In the video, he also talks at great length about the stocks he bought with the proceeds from the sale. So click right over here to check that out, and I hope you guys have a great day.